Hello everyone, welcome to BDO's Financial Reporting Update webinar for June. If you have any questions, then time permitting, we may be able to answer them at the end of the webinar. Please use the Q&A function on the right-hand side of your screens and direct your questions to all panelists.
Good afternoon, and welcome to what's our first financial reporting update for 2019, since unfortunately we had to cancel our April webinar. I'm Moses Surfety. I'm a director at BDO's financial reporting team. I'm joined today by Elisa Noble, who's a senior manager in the financial reporting team, together with Simon Jones, who is a partner from our valuations team. So today we're going to focus mainly on the new requirements that are effective from 1st of January 2019. First, we're going to discuss IFRS 16 leases, and we're going to cover in some detail incremental borrowing rate. Then we're going to cover other IFRS amendments and IFRICs which are effective in the current year. We'll also then have a quick look at UK GAAP updates and have a deep dive into changes to narrative reporting, in particular the Section 172 statement. And finally, we'll touch on some Brexit updates that affect financial reporting. So what's new in 2019 from an IFRS perspective? You'll see on this slide here there's quite a few. We've highlighted IFRS 16 because that's the largest one and the one that's expected to have the most impact on financial statements. But there are a few others which may or may not affect you. In terms of the ones we're going to touch on today, we're going to touch on the amendments to IAS 28, long-term interest in associates and joint ventures, and also IFRIC 23, uncertainty over income tax treatment. The others are covered in our IFRS in Practice publication, which I'll mention later. So in terms of IFRS 16, we expect that IFRS 16 transition projects will be well underway by now, especially for those who are having to prepare interim financial statements at the end of June. This slide is just a reminder of key questions that you ought to be asking yourself or have asked yourself when doing the transition. Key thing is lease definition. Have you been able to identify all of your leases? In the past, there may have been embedded leases in some contracts, which, assuming they were operating leases, you may not have identified as a lease. So again, that's just been a bit of work, extra work that you may have had to do. In addition, those contracts may have some non-lease components. IFRS 16 has some requirements and expedients that you may be able to take, i.e. to combine them with the lease components when measuring your lease liability. In addition, we've got scope exemptions, short-term leases and low-value leases. You've got to decide whether or not you're going to bring them on balance sheet or leave them out. There's also lease term, which again is not a new issue in connection with leases, but options to renew, extend and terminate, perhaps in particular with operating leases, you may have to look at, or what were operating leases you may have had to look at a bit more carefully than you perhaps did in the past. Another issue, variable lease payments, if you've got any based on an index or in substance fixed variable lease payments, how are you going to account for those when you adopt IFRS 16? And finally, but not least, your discount rate. So this is going to be a key input into measuring your lease liability and in consequence your right of use asset. The standard requires you initially to use the rate implicit in the lease, but if you don't know it, then you have to derive an incremental borrowing rate. And this is quite key because there may be some key assumptions and estimates that you will be making when deriving that number. And having provided that brief introduction, I suppose, to IFRS 16, I'm going to hand over to Simon, who's now going to talk about determining the incremental borrowing rate.
Thank you, Moses. So I'm Simon Jones. I'm a partner in the valuation team, as it says, or said on the previous slide. We address IFRS 16 in two ways within the valuation team at BDO. One is for our non-audit clients. So we help them largely with determination of an incremental borrowing rate or other aspects around that. The second way we're addressing IFRS 16 is as a service and support to BDO's audit clients. So we are reviewing the work that is provided to our audit teams as a specialist function, with that work either coming from other third-party advisors or from clients themselves. So these slides are based on a combination of our experience of that and what is set out in the standards. As explained, sort of a key area is the incremental borrowing rate. So really, that's the focus of what I will be talking about. So if you're familiar with the standard already, apologies for some of this, but effectively the initial balance sheet entries, they're determined by the lease liability. And the lease liability is measured as the present value of the lease payments that are not paid at that date. Now the standard says the lease payment should be discounted using the rate implicit in the lease, or if that's not available or can't be readily determined, the lessee's incremental borrowing rate. Now, in most cases, a lessee won't have access to information that allows them to calculate the rate implicit in the lease. So what that means is it leaves you with the need to establish an incremental borrowing rate. The incremental borrowing rate, as it says on its slide, and certain terms are deliberately underlined here, is the rate of interest that a lessee would have to pay to borrow over a similar term and with similar security the funds necessary to obtain an asset of similar value to the right of use asset in a similar economic environment. So the underlying terms flow down to the diagram at the bottom of the screen. So similar economic environment, term and value effectively lie, in terms of building up an incremental borrowing rate, they feed into a base rate for economic factors. The rate that the lessee would have to pay to borrow, they feed into the financing factor component of an incremental borrowing rate. And with a similar security, that feeds into some asset-specific factors that feed into determination of an incremental borrowing rate. So, whilst it might seem simplistic, because oftentimes the lease liability and the resulting right of use asset are material in the financial statements, calculation of the incremental borrowing rate can be more complex than it might seem on the outside. So let's explore each of those individual factors. Firstly, the base rate for economic factors. Typically, when we're providing a service for third-party clients, and certainly when we've seen this from other third-party advisors, the starting point for that is a risk-free rate derived from government bonds. Going back to the definition, that explains the similar economic environment. So that risk-free rate should consider the geographic location of where the lessee operates. Now, there's some nuances in this. So if you've got a lessee that's based in a Eurozone country, do you use a single rate across the Eurozone, say for Germany and Greece? Whilst there are different bond markets in those territories with different underlying yields, obviously the economic factors are very different, but there's an argument to say that in the US, you've got different economic factors in New York City versus the Midwest, for example. So whilst a government yield curve is a good starting point, it's not necessarily the be-all and end-all. One other thing that is very important is you're relying on evidence from government bonds, which are effectively bullet payment instruments. So bullet payments means you receive the majority of your payments at the end of that term. whereas when you're thinking of lease cash flows, they're spread over the term of the lease. So all else equal, a bond with a principal outstanding for longer, i.e. a bullet payment bond, you would expect that to have greater credit risk than a bond where the principal is amortised over the loan life. So given the profile of cash flows for government bonds, it may be appropriate to apply a base rate for a tenor that is shorter than the remaining lease term. For example, you might conclude that a 6-year bond yield is an appropriate base rate for a 10-year lease, simply because of that cash flow mismatch. But to all intents and purposes, you've probably got a portfolio of leases with different remaining terms, and given that, we would expect to see an underlying yield curve schedule for various tenors with some judgments applied around that. The second factor in the build-up to the incremental borrowing rate that we consider are the financing factors. There are some key considerations within that. Number one is identifying the lessee. And then over and beyond that, it's calculating a credit spread to apply to the base rate that we've just calculated, and then potentially making some adjustments to that credit spread related to currency, which I will come to later. So the first point in terms of identifying the lessee, the standard talks about the lessee specifically. And the entity entering into the lease is generally not the parent entity, but a subsidiary of that parent entity. So when you're thinking about financing factors, you need to consider the credit worthiness of the entity entering into the lease, i.e. the subsidiary, although the credit rating or the financial standing of the parent may provide some guidance. So for example, if you can calculate a group incremental borrowing rate, or a parent borrowing rate, that might be appropriate in circumstances where your subsidiaries that are entering into their leases don't have their own treasury function. So all funding for the group is managed centrally by the parent entity. Or it might be appropriate if the credit standing and profile of the parent more significantly affects the pricing of the lease than the credit standing and profile of the subsidiary entering into the lease. But the key point is the credit risk of the individual subsidiaries is likely to be greater than the credit risk of the group as a whole. So once you've determined who the lessee is, it's then a case of moving on to calculating a credit spread. Now, if you've got your own borrowings, if you've got public debt, if you've undertaken a private debt placement, calculating a credit spread should be relatively straightforward. It's a simple case of taking a government bond yield and subtracting that from your cost of debt. However, in many circumstances, and certainly as we're seeing, either that borrowing isn't there, companies are completely unlevered, or if the borrowing is there, it was entered into some years ago such that the rate of interest that you're paying on that borrowing is not necessarily relevant. So in those circumstances, what we would typically try to do is calculate a synthetic credit rating for the entity in question in order to determine a credit spread. And there are a number of ways to do that. So I'm not going to go into great detail as to how we would do that. But I do give an example at the bottom of the sheet whereby you could potentially follow the rating agency's published methodology for the relevant industry sector. and use that based on financial metrics, potentially alongside some of the qualitative metrics that they use to come up with a credit rating for the entity in question based on its performance and so on and so forth. So the table at the bottom of that slide shows synthetic credit rating of BB based on Moody's ratings and what that would mean in terms of credit spread. And what you'll notice there is you get different credit spreads at different tenors. So there's not a single spread necessarily at different bond tenors. So once you've got to that point, as I said previously, it may be necessary to make additional adjustments. And the reason why you might make those adjustments is, say you've got a lease in the UK, there's not a deep corporate bond market in the UK. So a lot of time you'll be relying on evidence from European or US bond markets. The cost of borrowing in dollars or in euros is not necessarily the same as borrowing in pounds. So this may mean you will have to adjust the evidence that you've relied on in order to get your initial financing adjustment in order to reflect a sterling borrowing rate. There are a number of ways that you can do that. The chart here just shows adding a simple premium to reflect the cost of GBP borrowing relative to euro borrowing. But we've also seen more complex methods applied whereby a series of cross-currency swaps are set up. The final thing to add to the equation then are the asset-specific factors. So we're talking about cost of borrowing for something that provides similar security. And we're taking leases over a variety of assets on the balance sheet probably. So you might have real estate, you might have some plant and machinery, etc., etc. And each of those provides different security potentially. Now, what you need to consider when considering security is the security is provided by the right of use asset, not the asset itself. So the right to use a building or to lease a building over a specific term is the security. It's not the underlying asset itself. So it's not the building. So when you're making an adjustment to consider security, and just winding back a little, remembering that the base rate plus financing factor that we've calculated previously is typically providing an unsecured lending rate because it's based on evidence drawn from unsecured lending. So making adjustments for security, we typically expect those to be downward adjustments to reflect the level of security, but these may be offset by other factors, for example, liquidity of the lease. But effectively, there's an asset-specific factor to feed into the equation, which then, as you'll see at the bottom of the slide, I give an example. Say you come up with an unsecured rate of 5.34%. We've determined that we've got more security with this asset, so we reduce this by 50 basis points. So we come up with an unsecured lending rate of 4.84%. Apologies for the loss of voice. But ultimately, as I said, it can be a relatively complex process to calculate an incremental borrowing rate, but we've got lots of experience of doing that. But the reason why sort of you need to pay some attention to it is that different incremental borrowing rates have very sort of varying impacts on both the balance sheet and the P&L. So taking the balance sheet first, the lower the incremental borrowing rate, the greater would be the lease liability, and hence the greater the right of use asset, and vice versa. So as a consequence, the lower the incremental borrowing rate, greater the net debt that you're reporting. So this is demonstrated in the graph at the top right-hand side of this slide, looking at the asset and liability position of a example lease with a 7.5% incremental borrowing rate versus a 2.5% incremental borrowing rate. And if you look at the blue and orange bars, you'll see that the asset and liability position is lower the higher the borrowing rate relative to the red and grey bars. But then if you look at the overall balance sheet impact, the lower the IBR, the lower the overall net liability, which we're showing in the graph on the bottom right-hand. So in other words, the lower the IBR, the greater the reported net assets, albeit the greater the net debt. So there's a balance sheet impact depending on the size of the incremental borrowing rate, and when your work is being audited, that impact may be material. Similarly, in terms of the P&L, so the P&L charge that you'll see comprises amortization of the right of use asset plus interest on the lease liability. Your low incremental borrowing rate gives you a higher right of use asset, which will give you a higher amortization charge, which is the red column versus the blue column in the chart at the bottom of the page. But that gives you a lower interest charge. So that's the grey column versus the orange column. So overall, what does that mean? That means that in early years, the lower interest charge outweighs the higher amortization charge, such that the overall P&L charge is lower. So the lower the IBR, the greater is the net profit, all else equal, in early years. So certainly, that's something that we're aware of, and when we're auditing work, something that we are looking out for. So that's a quick canter through some of the issues as it relates to the incremental borrowing rate. I'll hand you back now to Moses.
Thanks, Simon. Definitely some food for thought there if you're preparing your accounts under IFRS 16 for the first time. We're just now going to touch briefly on disclosures. And in particular, the disclosures in interim reports. The question we get asked quite often is, what should I disclose about IFRS 16? Now, considering that the IFRS 16 would have probably a significant impact on assets and liabilities reported, you would think that there would be some guidance on this. Unfortunately, there are no specific disclosure requirements within IAS 34, so it's down to management judgment as to what you put in. The FRC, the Financial Reporting Council, have announced that they will do a thematic review of IFRS 16 interim disclosures. They did something similar last year for IFRS 15 and IFRS 9. That isn't going to help you in the short term because those reports will only come out probably in October or November. So if you do have a later start date to your financial year, you might be well placed to take advantage of their observations. But they have said that they expect disclosures to be of a sufficient level of granularity for you to understand the impact on the business, and they have pointed you towards the guidance in IAS 8 accounting policies. IFRS 16 also contains a fair amount of guidance on for the period of adoption, so you should probably also look at those. On this slide, we produce what perhaps we would think is best practice so you ought to be including a full description of the lease accounting policy, explain how it's different from your old one, key judgments made, exemptions taken. So in terms of exemptions, you may or may not have taken the low value leases exemption, or for short-term leases. Again, it'd be good if there's an explanation of how you're treating those. Also give the amount of the adjustment for line items that have been materially affected by IFRS 16. What transition approach you've taken. Again, IFRS 16 has two transition approaches. You can go full retrospective, whereby you restate comparatives, or modified retrospective, whereby any adjustments are taken as an adjustment on the first day of the current accounting period, that being 1st of January 2019. Again, you would probably also explain those adjustments that have been made. If you report earnings per share, the method of adoption would have affected that. So again, you probably want to explain that. And similarly, if you use alternative performance measures such as EBITDA, you probably want to explain to users how they've changed. If you've gone for the modified retrospective approach, you probably might want to give a pro forma figure for the prior year to aid comparability, because when you do modified retrospective, you haven't adjusted your comparatives for the statutory accounts. So that's just a list of the things that you might consider disclosing. Moving on to the amendment to IAS 28. This is quite a narrow scope amendment that can be adopted early, but has to be adopted in the current period. And it could have a significant impact where entities have lent monies to associates in joint ventures, where the loan forms part of the net investment, i.e. it's not expected to be repaid in the foreseeable future. This clarification states that you first apply IFRS 9 financial instruments, i.e. the impairment model, to that loan before doing any equity accounting. Again, this might be a change in approach for companies, so we thought it would be worthwhile to flag this one. So this next interpretation is IFRIC 23, uncertainty over income tax treatment. This was a gap in IFRS. It didn't use to address it, so there was some diversity in practice. Some people looked at US GAAP, some people may have looked at IAS 37. In terms of the impact of this new interpretation, is that it's likely that you will recognize provisions for uncertain tax treatments earlier than you might have done in the past. On the slide there, you just set out what IFRIC 23 is addressing, but key to it is the bit at the bottom. What an uncertain tax treatment is, tax treatment for which there's uncertainty over whether the tax authority will accept the treatment that you've adopted. So IFRIC 23, it addresses four issues. It addresses whether you consider uncertain tax treatments separately or together, and the guidance there tells you, well, it depends. If the method that better predicts the resolution of the uncertainty is the one you should adopt. So you should split them if they are largely independent. If there are interdependencies, you ought to be considering the uncertainties together. The second box on the right, this is the key change, that the standard is quite clear that you assume that the tax authority will have full knowledge of facts and circumstances when making the determination whether to accept your tax treatments or not. In the past, some people may have factored into their assessment whether the tax authorities would pick up a problem. So that's now ruled out. So it's quite a key change. It then also tells you, well, how you do it, and we'll cover that on the next slide. And there's also guidance as to when you consider changes in fact and circumstances and how you account for those. And you would account for those using IAS 8, the changes in estimates, or perhaps IAS 10 if it's a post-balance sheet event. So this graphic just shows when you would apply IFRIC 23 and when you don't. So on the left-hand side, if the probability that the tax treatment that you've adopted is going to be accepted by the tax authorities in excess of 50%, then you would use those assumptions when you compute your current and deferred tax. And what that means in simple terms is that your tax charge will, in your account, or the tax figures in your account will align with those you put into your tax returns. On the right-hand side, when the probability that your preferred tax treatment might not be accepted by the authority is below 50%, then you have to apply IFRIC 23, and IFRIC 23 then tells you how to measure that liability. Again, just to put it simply, then the tax charge in your accounts won't be the same one as you have in your tax returns. So how do you go about measuring your tax charge? Again, the standard tells you there's two ways of doing it. You can do the most likely amount or the expected value method. When do you use each method? Well, it depends. If the most likely amount better predicts the resolution of the uncertainty, or i.e. you've got like a binary outcome, then you use the most likely amount. Alternatively, if you've got a range of values that might be a liability, then you would use an expected value approach. And this is just a reminder of our updated publications on IFRS. So we've updated our publications on IFRS 9, 15 and 16 to reflect latest changes in thinking in practice. And we've also, our publication on new and forthcoming standards, which is slightly briefer, has also been updated. You can find those on our website, and the link is there at the bottom of the slide. So moving on to UK GAAP, there have been some changes, perhaps not as many and not as far-reaching as the IFRS ones, but the Financial Reporting Council updated FRS 102 last year. The effects are applicable from 1st of January 2019. In terms of the key changes, loans from direct to shareholders to small companies are now exempted from the requirements to present value them. So if you have an interest-free loan or below market rate of interest loan, you can just measure it at the transaction value. Business combinations, the guidance has changed such that the only the intangibles that need to be recognized and capitalized on business combinations are those that are separable and arise from contractual or legal rights. The previous definition was separable or arise from contractual or legal rights. So what we're expecting is that we're expecting to see fewer intangibles recognized now, perhaps not going back to the days when the only intangible recognized was goodwill, but that's a matter of judgment that will need to be exercised if you have a business combination. There's also a change for the accounting treatment of investment properties that are leased within a group. We're now going back to the old UK GAAP accounting, whereby you do not have to fair value those investment properties. You can still choose to do so, but you do not have to fair value them, but you have to carry them at cost, less depreciation. And there are other amendments, in particular in connection with, there are a few disclosure changes. In terms of adoption, you can early adopt them, so if you're still preparing your December 2018 accounts, you can early adopt the amendments, but you've got to adopt them all, including the disclosure changes, so just watch out for that. The amendment for directors' loans to small companies, that can be adopted in isolation. We've updated our model accounts for these changes, so they do show that we are an early adopter, and you can access those using the link on the right-hand side of the slide. There's still some changes to FRS 101 and 102 that just worth flagging at this point in time. FRED 70 is an amendment that basically prohibits FRS 101 adopters from adopting IFRS 17. There's still some time before IFRS 17 becomes applicable anyway, but the reason for this amendment or change is because IFRS 17 is deemed to be incompatible with the UK law as it stands. We then got FRED 71, which was an amendment issued in May 2019, so now it's been endorsed, and it covers off the accounting for multi-employer plans when you're moving from defined contribution accounting to defined benefit accounting. And the treatment that you do there is that you recognize the net defined benefit asset or liability, but any difference you take to other comprehensive income on initial recognition. There was some debate as to whether that should go to profit and loss or to equity. They've landed on other comprehensive income. This is effective from 1st of January 2020. And that's it on the UK GAAP changes. Now Elisa will guide us through the changes to narrative reporting requirements in the UK.
Okay, thanks, Moses. So what we'll look at next are some of the new disclosure requirements for large companies affecting the strategic reports and directors' reports from 2019 onwards. And in particular, the Section 172 statement, which is an entirely new requirement. So hopefully most of you will have heard by now about the quite substantial changes announced in 2018 to large company narrative reporting. We did talk about these in some detail in our webinar in September 2018, so you may like to listen to that if you haven't done so. So as a reminder, the new regulations introduce 6 new disclosure requirements, which each has a slightly different scope. So actually figuring out which ones apply to you might be a little bit complicated for some companies. Today we will focus mainly on the first item on this list, so the Section 172 statement, and just very briefly we will also touch on items 2 and 3. I think we'll probably come back to the last 3 items, including corporate governance, in greater detail in our next webinar. Okay, so the Section 172 statement, who does it apply to? So this new statement will apply to all large companies as defined in the Companies Act. So that means large subsidiaries and parents also in their individual accounts. There are no exemptions if you're included in your parents' consolidated accounts or if you are a private company. So size is really the key thing here, and for that reason we've got just a reminder of those size limits on the screen for you, and remember this is a case of meeting or breaching 2 out of 3 for 2 years in a row. The requirements apply to periods beginning on or after 1st of January 2019, so primarily we'll see companies beginning to report on this basis in 2020. However, do watch out for any short periods of account, in which case you might have to prepare this statement sooner. So, on the next slide, sorry, if we can get to it. There we are. So where does this go? This needs to be a separate statement within the strategic report. And that means it can, exactly where you position it is flexible, but it does need to be a separate statement. It wouldn't just be perhaps a small paragraph of text within other aspects. And it also needs to be included on a website. So for quoted and AIM companies, that of course is nothing new, already including annual reports on your website, but for unquoted and private companies, you may not have been doing that so far. So you'll have a choice of either placing your entire annual report or the whole strategic report on your website, or alternatively you could put just the Section 172 statement on either your website or perhaps your parent company's website if you don't have a separate one for each entity in the group. But if that is a separate statement, then you'll need to take care to avoid cross-referencing to other parts of the annual report, because that would need to be a standalone document that people can read in and of itself. So what is the Section 172 statement? What is Section 172? So this is something that will describe how the directors have had regard to their duties as set out in Section 172 of the Companies Act. And Section 172 directs companies in that they have a duty to promote the success of the company. It's an acknowledged notion that company success depends on fostering broader stakeholder relationships and considering the external impact of a company's activities, including in the long term. So the Section 172 statement is something where the company should explain how all of this has been considered. Section 172 sets out 6 areas that directors should have regard to when seeking to promote the success of the company. We'll look at these on the next slide, and basically in this report you will be trying to explain how you have done so. The extent of these reports will vary slightly from company to company, and they should focus on matters of strategic importance and demonstrate that meaningful discussions have taken place. So on the next slide here, we have these 6 areas that companies and directors should be considering. The first one is to consider the likely consequences of any decisions and actions in the long term. Also to consider all of the relevant stakeholders, so that will include employees, suppliers, customers, others, community, the environment, and also consider how you are maintaining a reputation for high standards of business conduct and acting fairly between members of the company. So what would this statement actually look like? We'll have to wait and see how best practice emerges. For now, we have some guidance issued by the Financial Reporting Council, the FRC, and the Departments of Business, Energy and Industrial Strategy, BEIS, in the form of FAQs. Those are useful forms of guidance. We do recommend you take a look at them. The FRC guidance has stressed that this is something that you shouldn't consider in a sort of checklist approach. It's basically about finding a way to tell the company's story about how Section 172 duties are addressed. Typically, you would focus on that idea of long-term success being considered when setting strategy and making key decisions, making sure that the statement demonstrates meaningful discussions took place, and setting out some detail about issues, factors, and stakeholders considered and the main methods of engagement with stakeholders, and basically explaining how that has affected decision-making in the year. Okay, so how would you actually go about doing that? Just a suggestion of how you might approach it. You might want to start with identifying the key strategic decisions in a year, thinking about how those, what kind of long-term impact they have. That might perhaps link to the risk management process that the company has. In order to consider how stakeholders would be affected by decisions, you've clearly got to identify the stakeholders. So there should really be a list of them. You might want to disclose a stakeholder map in your annual report. Do look beyond the first ones to consider would be employees, suppliers, customers, but that there could be other significant stakeholders, pension schemes, the environment, the community perhaps. Then consider how the directors have engaged with each group of stakeholders and explain that in your statement. So this should ideally be something quite specific, referring perhaps to specific surveys or meetings with each stakeholder group, and then explaining whether and how whether there were any conflicts between the stakeholders and how those conflicts were resolved. So just thinking of an example of a type of decision that could be relevant, maybe a company decides to exit from an unprofitable segment of the market. So in thinking about the longer term impact, of course, the considerations there for the shareholders might be to preserve cash and business continuity. There could be perhaps some conflicts of interest with employees and local communities due to perhaps some job losses. So a company might, in drafting a Section 172 statement, might look to a way to describing how some of those questions on the screen were addressed. Okay. Now, since this reporting requirement is not yet in place, there aren't very many examples out there of actual Section 172 statements. But having said that, there are some of the perhaps larger PLCs, for example, who have started on a voluntary basis, including Section 172 statements in their annual reports. So you might just want to take a look at some of these in preparing to draft your own. On the screen, as an example, is one from United Utilities Group. It's just sort of a random example, just for illustration. You'll probably struggle to see the detail on the screen there. It's quite small, but the things to pick out would be this is just a way to show how a company has set out some of the key strategic discussions and decisions in the year, cross-referencing to information throughout the rest of the annual report, and setting out the key stakeholders that were affected and considered. Then this particular annual report has a lot of information elsewhere. For example, there are diagrams setting out the stakeholders, who they are, explaining why, then explaining how the company has engaged with those stakeholders and how they create value for them, with sort of color-coded referencing, linking back to strategic themes and material issues discussed elsewhere. Linkage is always very helpful in the front end of an annual report. Okay, so as you can probably see from all of that, this drafting the Section 172 statement might take a bit of time and effort, especially in the first year. So do take a look at the guidance from the FRC and BEIS, and it's worth noting that there'll probably be quite a lot of overlap and perhaps cross-referencing between this statement and other parts of the front end of an annual report, so discussions about business model, principal risks, and so on. And cross-references are fine so long as they are clear and the requirements are met. So just the last thing to look at then, these were from that very first slide of changes on narrative reporting. These were the items 2 and 3. So 2 other disclosure changes coming in from 1st of January 2019. And these are changes into for the director's report. So there is a new requirement to summarize how the directors have engaged with employees, how they've had regards to employee interests and the effect of that regard on principal decisions. So this is clearly linked to the Section 172 statement, but the difference here is that this is required for all companies with more than 250 UK employees. So that is even if you do not meet the large company criteria otherwise, and therefore even if you don't need to prepare a Section 172 statement. Also, if for some reason you consider this matter of employee engagement not to be of strategic importance, so as to discuss it in a strategic report, then you would still need to include it in your director's report. But if you are preparing the Section 172 statement and covering all of this information there, then it will be perfectly fine to include just a cross-reference from the director's report. The third requirement is similar, and this is about engagement with suppliers, customers, and others. And this applies to all large companies based on Companies Act size criteria. Again, going into the director's report, and that can be covered by cross-references. Okay, so that concludes our updates about changes to narrative reporting. Just the very last topic to bring to your attention is a brief update about Brexit. So, of course, uncertainty relating to Brexit continues out there, and we just wanted to bring your attention to a series of letters that were issued jointly by the FRC and BEIS in February this year. So the main message, just to be aware of, is that nothing much should be changing on exit day, whenever that may be, to basically reporters in the UK. So, for example, UK financial reporting laws that are derived from European legislation will continue to apply unchanged. So, for example, our non-financial reporting requirements. All UK companies currently applying EU IFRSs will continue to do so until the first financial period starting after exit date. In other words, EU IFRSs are used for all periods starting on or before the exit day. Then after exit day, we'll have something new, so UK IFRSs. Now, those will be identical to EU IFRSs at the time of exit, but we will have a new UK IFRS endorsement process and a new endorsement board, which will be set up. And details only known after this EU exit happens, and whether or not there will be any future divergence is not something that is known at this time. Otherwise, just companies who perhaps have listings in the EU or EU companies with listings in the UK or who have branches one way or the other, those companies probably need to take a closer look at their affairs, just to see if any detailed rule changes affect them. And other than that category of companies, also anyone who is making use of dormant company exemptions and or consolidation exemptions that depend on having an EEA parent company may need to revisit the availability of those exemptions because there may be some changes. Very last thing is to just note that each of the AIM rules, the listing rules, and the disclosure and transparency, the DTR, all have draft rules in place that will by and large ensure that the same rules apply to affected companies before and after exit date, and indeed introduce the requirement for UK IFRSs on exit date. So that brings us to the end of our updates. I do realize we've taken slightly longer than 45 minutes today. We will sometimes see if there are any questions, but it looks like we haven't received any questions today. So that therefore concludes our financial reporting update today. We do hope you found it useful, and we hope you join us again next time.